Hi, this is Scott Murray, and welcome to the Daily Economic Market Shout for Tuesday, March 21st, 2023. It's great being with you here today. Today, we're going to start looking at economic numbers that have come out since the start of the banking turbulence that we've seen over the last few weeks. Here we're going to start in Germany with ZEW. This is expectations. This is real time in the month of March. And what we see there is a decline, 13 from 28. The previous reading expectations were about 15, so a little bit of overshot on the decline in terms of the marketplace. But what's interesting inside the numbers, we see autos and construction considerably negative. No improvement there. Construction is down 82. Auto down 24. So you see the impact of higher interest rates and also concerns about a key industry, autos, which actually works throughout Europe, since most of the rest of Europe is a part supplier for the German manufacturing of automobiles, a key export for them and an import for the parts side of the equation. Got similar, now this is a February reading, but we do see in France weakness, -4% year over year retail sales growth from -2. And that tells us there is still sort of this lingering concerns. Remember, pension reform, political wage concerns in Germany are all creating this political instability that the bank situation is not helping. And that's something that's overhang. Now it's considerably better than what we saw back. We saw a negative 40 from when the when the Ukraine war started. It had been 54 in the previous month. So as we look at this 1-year anniversary, we recognize that we have improved from the -40, and we saw considerable negative numbers throughout 2022. So an improvement in Europe, but this is the banking crisis is an overhang that continues to percolate here. Here, we got the Fed reading for Philly Fund. This was on the service side of the part of the Philly Fund's reading. We usually get those a few days after we get the manufacturing. What's important about the Fed readings is they are real time. They're telling us directly what the economy is doing. We've seen both out of the Empire, both manufacturing and services, and now the Philly, which is manufacturing services. And I should say the Empire is the New York Fed. We have seen new orders retreat. And that's an important driver of manufacturing activities. Would not be surprised if we get to the flashes that then at the end of the month, we'll start looking at the readings for. This month, we will see the overall concern about new orders, not expecting that to take ramifications into employment, but it's worth keeping our eyes on as we move forward. And that then speaks to the topic of the day. Treasury Secretary Yellen is out trying to reassure markets that there will be some deposit insurance available for other entities that may not qualify for previous statements. And that's really the quagmire we get into. Who's going to be favored and who's not going to be favored. And that's going to take a long time to unsettle. It's going to create a velocity of money. The velocity of money is going to leave several institutions at peril. It's very typical, particularly when you see short-term rates higher than the Fed funds rate. This is like the 1 month above significantly, let's say 10 basis points above the Fed funds rate. There is an encouragement from money market managers to move out a little bit of duration, but 1 month is 1 month. Not immediate. And so when you have people running to the doors to take out deposits quickly, that provides angst. And when you realign the deck chairs, it makes it very hard for markets to anticipate and managers to anticipate in their normal functions, particularly given the reserve system that we have, which means that just like the Bailey building and loan, not all the money is sitting in that institution, and therefore everyone can't go and get it at the same time. That's not how the money system here in the United States and most of the enterprise part of the world works. So we want to keep focused on these signs, but recognize that there will be some ups and downs, there'll be some clarifications, and policy typically doesn't work. Policy error leads to recessions, and I still think we're in that vein. The leading indicators are pointing to the end of this year, where credit is now another driver. It's a leading indicator, and it's a driver negatively right now in terms of the economy. So we want to watch that overhang as we work forward. But the early signs are for modest real economy impact. However, it's early days in the banking crisis. This is Scott Murray for the Daily Economic Market Shout. Thank you for joining me.